Jamil, I won't take any more time. I'll just invite him. Please just listen and enjoy. Thank you.
All right. Good afternoon to everyone. And this is a fairly intense topic, and I'll try and make it as practical as possible. Because I think sessions like this, we were just talking during the break, the idea is not for you to go back and say, I am an expert in Ind AS 103, Ind AS 110 or whatever there is. But the idea really is that this discussion should trigger some thoughts to say, how will this impact my company, or how will this impact whatever I do, and how will it be different from what I have done things in the past, and how will I cope up? I think that's really the debate I want to trigger through this discussion. When this offer was made to me to speak, they said it's a very complex topic, so you have 3 hours. Now I can speak for 3 hours, I can cover the whole of IFRS actually, right? Because beyond a point, there is a lot of stuff, but what is relevant is probably precise if you know where to look. And I think that the trick is to say, where do you look, and therefore how do you get to the right answer, and hopefully that's what we'll do in this discussion. I will speak for around 90 minutes, and then I have kept around 15 to 20 minutes for a Q&A, 15 minutes for a Q&A. But if you have a burning question in the middle, please do kind of raise your hand, and we'll see how we cover that. So that's the format I want to follow. As an introduction, I've been doing this for 20 years now, practicing international reporting, and I've seen a lot of these concepts being put to practice. So again, hopefully some of this will come to light during the discussion. Okay. Now in 20 years, I haven't figured out how to make this work. 1 minute. Yeah. Okay. All right. So we got this. I'll give you a brief overview of what these two topics are about. We'll then delve into business combination, which is nothing but acquisitions. So we'll deal with acquisitions. We'll then go to consolidated financial statements, touch upon joint ventures, and then wrap it up. So that's really the format I would like to follow. Okay. The first thing I would like you to understand is that there are some fundamental differences between the way we do Indian GAAP accounting and Ind AS or IFRS in these two areas, which is acquisitions and consolidation. In many other areas, Dolphy I know spoke about revenue. You will hear other topics later on, employee benefits maybe. Indian GAAP over time has moved quite close to the Ind AS standards or to IFRS through conscious attempts of our standard setters. But these are two areas where we have very doggedly remain close to what we had without really changing to what the international norms are, which is why the impact is going to be so much more in these two areas. So that's the first thing I want you to know, that the changes are not peripheral. The changes are not about, we will change this, we will change that. Fundamentally, the way you account for acquisitions and the way you prepare your consolidated financial statements will change for many companies, and that's the concept that we should appreciate. And the two specific areas where the change will be is there will be a lot more use of fair valuation. So a lot of acquisition accounting, as you will see, will be driven by fair valuation of assets and liabilities. So very different from what we've done in the past. And second is there will be a lot more judgment, and I'll illustrate that as we go on. So more use of judgment, more use of fair valuation, which is what fundamentally changes things for us. There has been, as you know, a lot of confusion in the way currently we account for goodwill in Indian GAAP. Let me step back out here. Can somebody tell me how many ways are there to account for acquisitions today? And I would like to open this to the floor because I like to do it that way. Does everybody agree there are 2 ways? Yeah? No. Is everybody okay with 2? Yeah, this is like an auction. Somebody can say 3 as well, somebody can say 4, right? There are actually 4 ways, okay? Because what you are referring to as 2 ways is a very narrow definition of what is an acquisition. Let me explain. An acquisition could be through one company acquiring the shares of another company, 100% of the share of another company. We call that way of accounting consolidation. We don't even call it an acquisition. And what we do there is we just basically take the purchase consideration, we compare it to the book value of the assets and liabilities. That's how we bring it into the consolidated financial statement, and we park as goodwill. That's the first way. The second way, which both of you, which kind of a few of you highlighted, is if you really have a amalgamation, which is a merger, you can either follow the pooling of interest method, which means again you bring the assets and liabilities at book value, and any difference that exists you charge it off against the reserve, so there is no goodwill that arises. Or if you have a merger, you can do the purchase method, or you do the purchase method in certain cases, in which case you could do either book value or you could do fair value, and the goodwill that comes in then you amortize over a period of 5 years. That's what the standard tells us to do. And there is a fourth goodwill as well, or a fourth acquisition. This is a real challenging one. Can anyone tell me what that fourth one is? Say that again. Reverse merger is a form of merger, so that's okay. Yeah, that's fine. There's a fourth way of acquisition. Sorry? What do you mean? Yeah, but what's that's consolidation. No. Okay, you're close. Acquisition not of a brand, but acquisition of a group of assets in what we call slump sale. What is a slump sale? It's an acquisition. The point I want to highlight is, just because something is covered by AS 14 does not make it a merger or an amalgamation. It could be covered by anything else in the world. So the first point you got to get to, which I'll get to as we think about it, is that going forward, it's not about the legal form of the transaction. It doesn't matter whether the company exists and therefore you do line by line consolidation, whether you buy a group of assets in a slump sale, whether you do a legal merger and do pooling, or legal merger and do a purchase. All of these are acquisitions, all of them, and they are all accounted only by one method. So that's a fundamental difference from the way we have been used to things. So think about that a little bit. And in all of these cases, you account for it at fair value, which means the assets and liabilities come in at fair value. In all of this, the goodwill that comes in, you don't amortize, but you test the goodwill for impairment. Today, let's just go through the motions again. If you do a goodwill on consolidation, do you amortize or do you not amortize? Sorry? You don't amortize. You generally don't amortize, but there are some people who amortize. Yeah, so just always keep that in mind. If you have a goodwill on slump sale, do you amortize or not amortize? Sorry, Deloitte. Where's the Deloitte answer? No, I'm sorry, I'm just picking on you. The AS 10 says that when you acquire a group of assets, and if there is goodwill, generally you amortize. Generally, okay. So there are companies, most companies amortize. Some companies say the word generally, generally kyun bola hai? If you said generally, then there can be exceptionally. So they don't amortize that goodwill. When you have a goodwill on actual merger, if it's pooling, there is no goodwill, but if there is a purchase method, you amortize, because the standard tells you that you amortize it for a period not exceeding 5 years. But as compared to all of this, when you bring it together under the Ind AS framework or Ind AS 103, you always have goodwill which comes in, and you always amortize that, or you never amortize that goodwill, but always test it for impairment. Yeah. So does that give you a flavor of where we are heading with this? Same thing with consolidation. Let's do the same test with consolidation. If you buy another company, when do you consolidate? If you buy shares of another company, merger ho gaya to khatam ho gaya, there's no company. But let's say if you acquire shares in a company, when do you treat it as a subsidiary? When do you treat it as somebody said joint venture, somebody said equity method? What's the rule we follow? Control, yes. Exactly. So if you have, and this is governed by our AS 21, AS 21 says if you either have a control, if you have a majority of the voting interest, or you have a majority of the board of directors, ability to appoint a majority of the board of directors, then you treat it as a subsidiary. If, however, you don't have that, but you have joint control, which is defined in our AS 27, then you do whatever you do under AS 27. What do we do? Proportionate consolidation. And if you do not have that as well, which is generally when you're more than 20% but not joint control, then you do the equity method of accounting. Yeah. Going forward, this does not hold good anymore. So what Ind AS 110 said is that for you to consolidate, you got to have control. You can have control even if you have less than 50%, and you may not have control even though you own more than 50%. And I think that's very different, because in every transaction where you acquire more than 50%, you will have to ask the question that do I really have control, or are there any negating factors? And in every situation where you hold less than 50%, you'll have to ask the question that is this really a situation where I don't need to control, or are there some factors which would lead me to control? And I'll talk about all of this later in the presentation. But the point I want to leave behind is that this is not tweaking around. This is fundamentally changing the way we account for acquisitions or we deal with consolidation. Yeah. So I think that's the point I wanted to make at this stage. Yeah. The other big change which you will see, which will come in, excuse me. Sorry. Hello, backstage. Just give me 1 second, please. Yeah. Just stop it, please. Yeah. This is why you're making too much noise. So, yeah. Sorry. Yeah. So, on joint ventures, can somebody tell me how we account for joint ventures today? Sorry? Proportionate consolidation. And that means that if you own, let's say 40% in a joint venture, you can take 40% of the revenue and 40% of the expenses. Going forward, that's not permitted. So under Ind AS, proportionate consolidation is not permitted going forward. Now that's a big change, and we'll talk about that later. So once again, I just wanted to give you an overview that fundamentally acquisition accounting, consolidation and joint venture accounting, all three areas are going to change going forward. Okay, let's talk about acquisitions first. The whole acquisition accounting under Ind AS is broken up into 7 steps. Yeah. Step number 1 is to identify the acquirer. Now, can somebody tell me why is this even important? Where could there be situations where you don't know who's the acquirer? Just speak up a little bit, yeah.
Due to multiple controls existing at a point.
Okay, fine. No, I don't think that's the right answer, but I'll come back to that. Yeah, okay. Sorry? What do you mean? No, that's okay, but ultimately there's got to be one acquirer. No, that is all very straightforward. You will know who controls. That's easy. The question we are trying to answer here is slightly different. Okay? Does anybody remember when ICICI Bank acquired ICICI? Some of you remember? It was some years ago. Legally, ICICI Bank acquired ICICI, which means that ICICI merged into ICICI Bank. Do you really think ICICI Bank acquired ICICI, or did ICICI acquiring ICICI Bank? Yeah, ICICI acquiring ICICI Bank. Why do you say that? Sorry? Much larger entity. Is that the only factor? No, that's not important. That's not important. I think we've touched upon a good. I'm sorry?
ICICI were having assets and liabilities.
No,
whereas ICICI Bank was not having.
No. I audited that for several years. They also had assets and liabilities. I'll tell you what the determining factors are, and I think you're all touching upon those. The first thing you determine is size. Okay. ICICI in this case was a much larger organization as compared to ICICI Bank. Second, after the merger, which shareholders have a majority of the combined entity? So in this case, when the merger happened, the former shareholders of ICICI had 73% of the combined entity, while the former shareholders of ICICI Bank had 23% or whatever. So which group of shareholders have the higher percentage? Who is the management? Does anybody remember who the CEO of ICICI Bank was? No, he was ICICI. No, not Mr. Vagul, he was ICICI. You answered the question. Who is the management of the combined entity after the transaction, and who is the board of directors? So you're right, Kamath, who was the CEO of ICICI, continued to be the CEO of the merged entity ICICI Bank, and Mr. Bagul, who was the chairman of the board of ICICI, continued to be the chairman of ICICI Bank. Mr. Sinor was the CEO of ICICI Bank at that time. Yeah. So the question is that not in all transactions is it very clear on who is the acquirer. Normally, it will be very easy to find out who is the acquirer. The guy who pays the cash, or the organization that pays the cash, is the acquirer. But when you have a stock transaction, or when there is a merger, or two companies come together and a new co is formed, you have to ask these questions now based on the shareholding, based on the size, based on the management, and based on the board of directors, that who has indeed acquired who. And why is this question important? This question is important because the assets and liabilities of the company which is acquired have to be fair value, and not the company which is the acquirer. So in this example, under Indian GAAP, ICICI Bank fair valued the assets and liabilities of ICICI, while ICICI prepared US GAAP, but that's similar. For its filing with the SEC, the assets and liabilities of ICICI Bank were fair valued, while the assets and liabilities of ICICI remained the same way that they were. You can see the fundamental difference out here at play. Yeah. So the first step is to determine that is it a very simple case where you know who the acquirer is, or is there some complication for the reasons that we discussed, that the acquirer, the accounting acquirer, may not be the legal acquirer. This, my friends, is what the gentleman on the right said. This is a reverse acquisition. So when the next time you use the word reverse acquisition, understand how it could translate from an accounting perspective as well. So step number 1, identify the accounting acquirer. Step number 2, determine the acquisition date. Now in India, who determines the acquisition date? Either the agreement or the court. None of them are relevant going forward. So you could have a transaction where let's say you started the negotiating the transaction in May of 2015, you kind of got to some agreement by July of 2015, you went and got your shareholders to approve it in September 2015, but let's say you needed some approval from the regulators, maybe SEBI, whatever, and you got that in December 2015. But you can still go today and in the agreement say that this is effective from 1st of April 2015. That's possible, right? That's the way we account for acquisitions today, i.e. we depend upon what is there in the agreement or what is there in the court scheme in the case of a merger. Going forward, the date of acquisition is the date when the closing happens, which means when the consideration is paid by the acquirer to the shareholders of the acquired company. If there is shareholder approval, when that shareholder approval is obtained. If there is regulatory approval, when that regulatory approval also has been obtained. When all of this is completed, that's the acquisition date. So in my example, the acquisition date would be December 2015 and not 1st of April 2015. Why is this important? One, the results of the acquired company, target company, are included in the consolidated financial statements. If it is just an acquisition of a subsidiary and not a merger, only for the quarter or only for the period from December to March 2016, while under Indian GAAP, we would have included it from 1st of April 2015 to the 31st of March 2016. Second, remember we said you got to do fair valuation of the assets and liabilities. That fair valuation has to be done not as of 1st April 2015, but as of December 2015, which is indeed the date of acquisition. So the whole concept of acquisition date and including the results of the acquired company in the books of the acquirer or on consolidation will change fundamentally. That's step number 2. I'm sorry? That is applicable for a merger as well. Yeah, so going forward, now this is a very good question. Will there be an appointed date? Will there be an appointed date or an effective date going forward? Now, nobody can stop anybody from putting an appointed date for an effective date. That date may be relevant as far as your legal obligations are concerned, and that may be relevant for law. But for preparation of financial statements in accordance with the accounting standards, the acquisition date will be when all the closing conditions are fulfilled, which is the way I described it. The only catch is, and so for any Indian company that prepares today, even today IFRS financial statement, they disregard the appointed date and the effective date, and they do acquisition accounting in IFRS per the point that I described. The only question that's worth asking, which is an open question, is that even though the Ind AS standards will be notified as a part of the Companies Act, there is a preface to the standards which says law will override accounting wherever there is a conflict. Now nobody is quite clear where does that go. Does it go to situations where fundamentally if there is a law which is a parliament enacted law, and if that contradicts with the accounting standards the law will prevail, or does it also extend to situations like these where a court which is approves a scheme under a section of the Companies Act? The jury is still out on this. This is one of the things that the implementation committee should think about to really say how this will kind of work out. So that's a very good question that's kind of come up. The third, let me just come back. Yeah, the third thing that you do is determine what is the consideration. Yeah. Now, if you pay cash, it's very easy that you paid cash. That's the consideration. But remember, a lot of acquisitions, mergers happen through issuance of shares of the acquirer. In which case, the question is, what is the value that you acquire to that consideration? Currently, different people do different things. If it's a listed company, generally you go back to the SEBI formula. You find out what is the SEBI formula say, and you say that's the price per share, which could be the 6-month average or whatever there is, and that becomes the value at which you record the consideration. Going forward, everything is linked to the market price or the fair value on the closing date. So in our example earlier, if you said December is the closing date and you issue 1 million shares in December, then whatever is the market price on that date multiplied by 1 million, that will become the consideration and not some artificial price determined based on the SEBI formula. So that's the you may still determine the number of shares to be issued per the SEBI formula, but once the number of shares have been determined, what is the accounting value of the consideration will be determined based on the market price on the date closing is achieved. So that's another big difference, and there's some complications around that which I'll talk about as we move on in the presentation. Step number 4 is you need to identify and measure all your identifiable assets, which means you got to fair value all your assets. So remember, we mentioned earlier that you take all the assets and liabilities of the company you acquired. It could be physical assets, so property, it could be real estate, it could be land. All of this has to be fair valued on the acquisition date. That's what you do. It could also include those assets which are not on the balance sheet. So for example, there could be brands, there could be technology, there could be patents which are not recognized in the books of the company you are acquiring because they were self-generated. All of those have to be fair valued on the date of acquisition, and that can be a challenge. We'll talk about that later. Similarly, you could have liabilities. So for example, the target company could have some contingent liabilities in their books. That's a contingent liability per accounting, but when you do fair valuation, if you were to determine what is the true value of that liability, it can't be zero, right? It may not be the full value of the claim that's made, but it would be some value. Put differently, if you had to go to somebody and say, will you take over this liability? Okay, will you assume the responsibility for this liability? To assume that responsibility, whoever is taking this over would expect to be paid something. That is the fair value. So you got to determine that based on the best estimate, probability, etc., what is indeed the fair value of all of these contingent liabilities as well, and that's what you do for each item of asset and liability which you are acquiring as a part of that acquisition. So think about that. Now, you may not acquire 100% of the company. So let's say this is an acquisition of shares. Let's say you acquire 60% of a company. The question then is, earlier we used to have the concept of minority interest. So we would consolidate an entity, and the 40% which does not belong to us in this example would be shown as a minority interest in the balance sheet. That minority interest in AS, you don't do that, that goes to reserve. So that's the difference between global IFRS and Ind AS. Can somebody tell me why would there ever be negative goodwill or a situation like this? Okay. So in a distressed sale this could happen, but it's possible that in a distressed sale the person could sell the assets individually and get the value of 3,200 in our example, right? Yeah, so you're assuming that the traded market price is lower than book value. Yeah, but that also can be very, very rare. Normally, shares would trade at least at book value or higher than book value. But yeah, you know, the biggest area where we've seen this happen is tax shields. Yeah, we've seen this happen in tax shields. So what happens in a tax shield situation is that the acquired company obviously does not have the tax shield in its books because they are loss-making company. They may not be in a position to recognize that. They may in fact see no value in that at all because frankly they have no future. But an acquirer may see value in that because after a merger, if they have a way in which they can monetize the tax shield, they may be willing to pay something, not the full value, but something which is higher than the book value. So normally we see even globally negative goodwill or bargain purchase coming in where there are tax arbitrage opportunities. I want you to know that, and I also want you to know that there is a difference between IFRS and Ind AS in this area. Okay. The other thing which is different about Ind AS as compared to what we do currently is that there is a concept of a measurement period which is a 12-month period from the date of acquisition. So let's say for example, company A acquires company B on 15th of March 2016, right? And they have to close their accounts for 2016. You have to do all of this and you only have a very short period to do this. What Ind AS says is that if you are not able to do all of this fair valuation, by the time you close your books, you can disclose that the values that have been assigned are provisional, okay? And subsequently, if there is any change during a 12-month window from the date of acquisition till 12 months after that, then that difference, instead of going to P&L, can actually go and adjust the goodwill. That's called the measurement period. So let's say you brought in some inventory or you assign some value to inventory as a part of the acquisition accounting, and subsequently you realize that you had misstated that inventory. That's not a P&L debit, that goes and makes an adjustment to goodwill. So that's a measurement period adjustment that is again different from what we do under Ind AS. So every acquisition that you do would follow these 7 steps before you get to the acquisition accounting being complete. Are we all okay till this stage? Concepts are clear? Okay. So I can ask you some questions now? Yeah? Alright. Okay. So just as a quick recap of the goodwill calculation, not amortized but tested for impairment. Consideration is always measured at fair value of the equity instruments. We talked about non-controlling interest, and it may include assets and liabilities which are not already on the balance sheet and contingent liability. Okay. This is another area where Ind AS is different than IFRS. A common control transaction is a transaction where let's take an example. Let's say there is company A. Company A buys company B. Let's say 100% of the shares of company B. Company B was controlled or owned by the same promoter of company A. So the promoter of company A, who owns more than 50% in company A, is the same promoter who owned this 100% of the shares of company B, and this transaction was sold. Now, at a conceptual level, you may argue, how does it matter whether the promoter, kind of the same promoter or not? But Ind AS distinguishes with such a transaction and says, if a transaction is a common control transaction, then you cannot do fair valuation. Okay? You have to do book value accounting. And the difference between the consideration and the book value of the assets and liabilities has to be charged off to reserves. Now I don't think people have understood the full implication of this thing. So let's assume in my example, company A paid the promoter, okay, 1,000 crores for buying the shares of company B, and let's say that the net worth of company B, the book value of the share is only book value of the assets and liabilities is only 300 crores. The 700 crores will be a hit to reserves on day 1. Yeah, this is a very unique accounting that Ind AS provides. If you compare this to what we do internationally or what is done under IFRS, this is one of the options. So IFRS also allows you to do this, but IFRS says that you also have the choice to do fair value accounting in the same situation, because if you determine that fair value accounting and recognizing the assets and liability, that fair value and recognizing goodwill is the right way of doing it, then that's what you do. You don't necessarily bring your reserves down on day 1 by doing this charge to reserve accounting. Ind AS also said that if you do this, let's say in my example, this purchase was done on 1st of April 2015. Right? So you present the 15-16 accounts on a combined basis. You also go back and change the 14-15 accounts assuming that you had this company was always a part of your family, which means it treats the purchase from the promoter as money moving from one pocket to the other. Now that may be true for most Indian promoters, but basically the accounting reflects that as opposed to showing it as an arm's length transaction, even if it is on an arm's length basis. So big takeaway: common control transactions at book value, big hit to reserves on day one, and you go back and restate past period, which is very different from the way we would do the accounting today under Indian GAAP. All right. I want to now touch upon some of the impact areas, additional impact areas that are coming up when we are looking at Ind AS and what are some of the challenges. I already talked about this, substance versus legal form. Accounting is not driven by whether it is a consolidation situation, merger situation, or a slump sale situation. In all cases, you will determine what is the substance of the arrangement, and if the substance is an acquisition, then you will account for it as an acquisition the way we've discussed. Sometimes it's very difficult to determine whether what has been acquired is a business or not. Can somebody tell me why this would be the case, or give me one example where this happens? Beautiful answer. You know what Ind AS says is that goodwill can only arise if you acquire a business, because only if you have a business will the business have some synergistic value or inherent value. If it's not a business and you're just acquiring assets, just think of it, if you're acquiring a building or if you're acquiring a plant which is not a business, then there is no goodwill. The entire amount that you pay to the seller has to be attributed to that plant. You can't say there is goodwill or anything of that nature, and you basically account for it as an asset acquisition. Where this gets very complicated is in some cases where you have a slump sale and you're not able to determine whether what you acquired is a group of assets or whether it is a business, and that is an important determination. I'm dealing with a very interesting case right now where a IT company, a very large IT company, is entering into an agreement where they are buying from another company, which is a bank. They are buying the IT division of that bank, which was a captive division. So that division used to perform captive services for the bank, and now this IT company is buying this division. What is it buying? When you say buying the division, it's taking over the employees. So those employees of the bank are now becoming employees of the IT company. It's not interested in any tools, rules and all, because it has its own tools, but it is taking some very specific kind of IT development programs, etc., that particular bank kind of uses. So it's acquiring that, and at the end of it, it's entering into a 10-year contract with the bank whereby the IT company will provide services to the bank, and it's paying $300 million for this. Now what are they acquiring? Are they acquiring a business or they're not acquiring a business? Acquiring a business, or are they only acquiring that customer contract? Is business? It's a business. A lot of confidence here on business. If they had done the same deal differently, which is they just entered into a contract with that bank and say, Mr. Bank, if I want to get this contract, and bank said, why should I give you this contract? It's very valuable. 10 other people want this 10-year contract, so you got to pay me something, which is not very uncommon in the outsourcing industry, and you pay something. That's contract acquisition. What you have now in addition is employees. Now you could argue those employees who are coming in, the IT company has similar employees who can do the same thing. So let me now strip this a little bit. Let's say if they took over in this IT division only 20% of the employees, and 80% they said, we have our own employees, you sack those 80%, we will take only 20% of the employees. Let's say they said, we want none of your tools at all, we have all our own tools, our own program. The lines can get very blurred, okay, on what is an asset acquisition. The reason why people want business acquisition in this case is because you get goodwill. Yeah, and I don't know whether Dolphy touched upon it in the morning, but the other problem is if you treat this as an acquisition of a customer contract, then potentially the amortization could go as a reduction of revenues. While if you treat it as a business acquisition, then the goodwill amortization is goodwill amortization. It doesn't even show up in EBITDA. Forget a reduction of revenue. I have seen a reverse argument. I had a situation where it was a business acquisition in a similar situation, But the CFO said, no, this is not a business acquisition. This is a contract acquisition. Can somebody tell me why the CFO would say that? No, but that's fine. But what, forget the technical answer. Why did the CFO in this instance want it to be not a business acquisition but a contract acquisition? Not tax. Tax was not a consideration. I'm sorry? But no, top line will be in both cases. In fact, the top line is better if you call it a business, because if you call it a business, then you get the full revenue, then the amortization doesn't reduce. But this guy was ready with reduced revenue. No, it's not. Balance sheet remains the same. Balance sheet does not change. What the market was evaluating this company based on organic growth versus inorganic growth. So if they called it a business acquisition, this would be inorganic growth. But if this was a contract acquisition, this would be organic growth. Now, what I'm trying to get to here is that this is huge, guys. This is not just about a bunch of us sitting in this room. There are some real implications of each of these evaluations, and each of them requires some very serious judgment at play. So think about that as you move forward. Yes. Can we have a mic there, please? A mic which works. Thank you. Yeah.
In case acquisition of a brand.
Yes.
Is that a business acquisition or asset acquisition?
Same consideration will be applied. If you acquire only a brand, then of course it's not a business acquisition. It's a brand asset acquisition. But where it gets complicated is, let's say if you acquire brand and some manufacturing facilities along with the brand and some customer contracts, and maybe you acquire or don't acquire employees. For something to constitute a business under Ind AS, you got to have three things. You got to have what is called inputs. You got to have what is called processes, and you got to have the ability to produce output. So each transaction that you look at is evaluated against these parameters to say, have you acquired a business or have you only acquired an asset? So if you acquired only a brand, it will only be a brand. Then you just get to brand accounting. Okay, shock number 3. Yeah.
Suppose you acquire Coca-Cola and not anything else. Suppose you acquire Coca-Cola, the brand.
Yes.
What's the value of the enterprise of Coca-Cola without the brand?
Yeah. If you acquire Coca-Cola, you acquire only the brand Coca-Cola.
Only the brand Coca-Cola and not the company.
That's a brand acquisition. That's simple. That's an asset acquisition. The question there to ask is slightly different. That once you acquire the Coca-Cola brand, will you ever amortize that brand or not? And the answer is no. Because Coca-Cola potentially would be what is called an indefinite life intangible, which means you cannot foreseeably see a Coca-Cola brand dying. So you don't necessarily say, 10 years is the maximum amortization period, so I'll amortize in 10 years. You don't do that. That's a different cycle altogether. Yeah. Okay. Acquisition costs are expensed under Ind AS. Now this is very controversial. I don't know whether you've sort of understood the implication of this. So if there is an acquisition and you incur legal costs, investment banking fees, due diligence costs, all of that is expense, P&L. Okay, that's not capitalizable, which is a very big difference from what we currently do under Indian GAAP, because we add it to the cost of acquisition, and that it can ultimately find its way in goodwill. Where in practice I'm kind of getting increasingly worried is with stamp duty. So if you have a merger, there are many cases where you have stamp duty which is payable, and the current analysis under Ind AS is that all that stamp duty has to be charged off to the P&L. It cannot be capitalized to the cost of the asset. And that's very funny, because if you had acquired, let me give you an example. Let's say you acquired a plant, okay, and you paid stamp duty on that transfer. That under Ind AS is capitalizable, because that's a direct acquisition cost of that property, plant and equipment. But if you merged a company with yourself, and because of the merger there was a stamp duty which was triggered and you had to pay that stamp duty, that's a P&L, that's expense. That's a huge impact, okay, and I don't think people are talking about this enough, and I think as we move closer to the implementation date, corporate India, and some of you will realize it impacts you a little bit differently than what you thought it to be, and I think we'll have some kind of debate out there. The other area where we see where Ind AS can be very, very, very tricky is contingent consideration. Let me give you an example. let's say company A acquires 100% of the shares of company B and pays, let's say, 100 crores for that acquisition. They also say, tell the seller, seller, you made several representations to us about the growth of this business and how it will perform. If for the next 1 year, in a 1 year period, the revenues of this business are higher than 500 crores, then we will pay you an additional 20 crores. Okay? Today, under Indian GAAP, the way we account for this is we do nothing on day one. If that becomes payable because the trigger is reached, you capitalize it at that point in time and it shows up as additional goodwill. That's what we do under Indian GAAP. Under Ind AS, you have to fair value this on day one. So you will value this thing and say, what is the probability of this happening? And then you will run some formulas, you will get to a bank and all that stuff, and you put a value to it. That value could be something, because it won't be zero, because there is a chance that it will happen. It won't be the full amount, because then it means that it is certain it will happen. The value will be somewhere in the middle. Ultimately, of course, the answer will be 0 or 1, right? It will be either 0 or 20 crores. That difference is P&L. Yeah. So this is another very, very unique concept, that if you have any contingent consideration, you got to value it on day one, and any difference between the actual payout and what you recorded on day one based on your estimate or a fair valuation is a charge to the P&L or a credit to the P&L at that stage. So contingent consideration is another area where we're seeing a lot of debate. Now let me make this a little bit more complicated. Same example. Let's say you paid the seller 100 crores in my example, and you said, Mr. Seller, if the revenues are more than 500 crores at the end of 1 year, I will pay you another 20 crores. But you have to be there as the CEO of this company and deliver this. Which means if you leave employment, even if you get to 500 crores, I will not pay you. Yeah, so it's possible that that guy leaves, or that person, the seller, who's also the CEO now, or who was the CEO who you acquired, if that person leaves, it's possible that 500 crores of revenues may still be achieved if he leaves, but in which case it will not be payable. Ind AS says that if you have any payout which is linked to a continuation of employment of the selling shareholder, then that's P&L, that's compensation, that's another form of salary. Now this is funny because the amount can be huge. This same 20 crores as an example, I have seen this go to $200 million actually. Yeah, so there are earnouts which are $200 million linked to people, a group of selling shareholders continuing in employment. In substance, maybe you are even paying for the business because it is contingent consideration. And you may say, if along the way I can get a lock-in into these selling shareholders, why not? But the moment you do that, you have a P&L as far as Ind AS is concerned. Right, wrong, I don't know, but that's really what Ind AS says. So you might again, if you are dealing with arrangements which have a compensation element, think about how that could play out. We talked about this fair value measurement. We talked about this. Okay, this is another interesting one. Step acquisitions. Can somebody tell me what are step acquisitions? Perfect. So let me take a very simple example. Let's say you first acquire 10%, and I'll make this simple because it's 4:45 and people are looking a little bit tired. So I'll kind of keep this simple. If you want it to be tough, I can make it tough as well, but I'll keep it simple. So let's say you first acquire 10%, and on 1st of January 2015 you acquired. I saw many people sit up. I like that spirit. Yeah, good job. So you acquired 10% on 1st January 2015, and then let's say on 1st of March you acquire another 50%, and it becomes a subsidiary. Yeah. Under Indian GAAP, what do? Whatever you paid for the 10% is your first tranche. Whatever you pay for the 50% is the second tranche. You add the two. You then, on the day when it became a subsidiary, which is in my example 1st of March, you do a fair valuation of all the assets and liabilities, 60%, do all the song and dance that I talked about earlier. Ind AS has one more step. It said, if you do that, then on the second date, which is 1st of March, you got to revalue the first 10%. So let's say if the first 10% you bought for 100 crores, and that 10%'s value has gone up to 170 crores by the time you get to 1st March, what Ind AS says is your consideration should be based not on the original 100 crores, but the 170 crores, and the 70 crores is recognized in profits. in that March, in that period. So this is the concept of step acquisition, that if anybody who has an investment and then you get to a controlling interest, the entire existing investment is also fair valued. That is included at the cost of acquisition, and the difference between that value and what you acquired it for, what you were carrying it at, that becomes another element of P&L. Yeah. So that's another big difference. We talked about common control transaction. And then we talked about this, court approved schemes. See, courts are not going away anywhere. Okay, courts will remain in this country. Until courts remain, consultants will remain who will advise the courts on how schemes should be done. And then there will be people like us who will be there to interpret the effect of all of this stuff. So it's going to remain a bit complicated. Here is a question. Companies have done schemes in the past. Okay, what do you do when you move to Ind AS for the first time on 1st April 2015, or when you do your opening balance sheet? The answer to that is fairly simple. If something had happened in the past and you decide to grandfather that acquisition, which is an option that's available to you under Ind AS 101, no problem, forget about the past. The question then comes is, what about schemes in the future? And we briefly touched upon that earlier, that ideally courts should behave themselves, which means they should understand that there is a requirement, the accounting standard, and therefore you got to follow that, but they will not behave themselves. So then we will have a conflict, and we'll figure out what happens, because the question then will be, will law override the accounting, or will accounting override the law? Because law, actually, this is not law, this is some judge passing an order, etc., etc. I may be sued for, what do they call it, breach of contempt of court, but whatever there is to it, it could happen. Where we are seeing a real interesting debate is, a lot of people have created schemes which will have implications in the future. So for example, I have clients who have created as a part of previous schemes what are called business development reserves, and the scheme said that in the future there are expenses like bad debt expenses or expenses on impairment that you can charge off against this reserve, and this reserve exists in the balance sheet at the 1st April 2015. The question is that after 1st April 2015, if a company charges it against such a reserve because of a scheme that was approved previously, is it compliant with Ind AS or is it not compliant with Ind AS? And nobody knows the answer to that right now. And this is another thing that our implementation committee should pick up, to say what do we want it to be? Because if we want to say that the court will forever kind of perpetually override the accounting standards, then this whole concept of having IFRS converged standards will not really achieve the true objective that we have. But we are seeing a lot of practical discussions around this, so you should be conscious and aware of it. Yes. Yeah, but in this case that will not come into play, because if the question simply is that if you have certain bad debt expenses, let's say in the quarter of June 2016, can you charge that bad debt expense against a business development reserve that you created earlier, or does it rightfully belong to the P&L account? That is the question to be answered, which is where we will have to deal with some of these issues. That is correct. So all of these are schemes before the certificate came into account. There are people, this is a mad world, okay? This is a completely mad world. I have clients who say that, exactly the point you made, that, these courts, they become real pain in the backside. They're now asking for some chartered accountant certificate and all. So can we merge some of our overseas subsidiaries into each other? Yeah, no court, no certificate, nothing, So this is a mug's game. The simple point that we have to ask as a country is, how long there has to be a stop somewhere. So yeah, no, I've seen those. Okay, now we've talked about acquisitions. Let me get to consolidation, which in a way is linked but slightly not linked, which is Ind AS 1110, which is modeled around IFRS 10. The first question that Ind AS 110 forces us to ask is, do you really need to look at voting percentage to determine control, or is there something else? And that something else, for this discussion, I will call it a structured entity. So the first question you ask is it a simple case of a parent company looking at a subsidiary or looking at an investee company and making the determination on whether it should be consolidated or not based on more than 50% and whatever we'll talk about? Or is this a structured entity situation? I'll give you 3 examples which will hopefully help you to understand this concept. The first example that comes up in practice is ESOP trusts. Okay. Now ESOP trusts, the way they are designed, is there are always independent trustees, okay. So they are on paper independent, the deed etc drafted by many of us, all said independent, very independent. But what do? The deed said they can't do anything. All they do is they have to, whenever option holder exercises the option, this poor guy allots the shares to the option holder. And who controls the grant of the options? The company and the compensation committee of the company. In many cases, the shares themselves are acquired from the company either directly or from the market based on funding that's been provided by the company. India then said, if these are the situations, then you don't have to worry about control and all of that. This is a structured entity. The activities of that entity are closely related to your business. There is no other reason why that entity exists, and therefore you need to consolidate it. Don't even worry about control 50%, 60% and all of that. So that's one example of a structured entity. But not all examples are as simple as that. I do a lot of work in the e-commerce industry. I don't know how many of you have experienced e-commerce, but it's a very, very complicated industry from a regulatory perspective. As you may know, FDI is not allowed in retail, in multi-brand retail. So many e-commerce players have different entities. So there is an entity which owns the main brand. That is the entity which you would recognize in a familiar manner. This is the entity which owns the technology, the platform, and all of that. This is the entity that does sourcing from all the suppliers, etc., who exist out there. But the sale is not done by that entity. When you receive your invoice, you will receive the invoice from another entity. Because the first entity, I'll call it entity A, sells the goods to entity B, and entity B then sells the goods to you. Entity B is often owned by independent people. Independent people, FDI compliant people they are. So they are individuals who own this in their own capacity. But what does entity B do? Entity B only procures goods from entity A, only sells goods to customers who go to the website platform, not even website, these days you don't even get website, you get apps, only apps, websites closed. You buy from entity A. Entity B does not provide similar services to any other customer, sole customer. So the only job is this. Entity A does not use anybody else to sell, only entity B. I think you got a problem in India. That's a structured entity. I don't care a damn about who owns the shares. I don't care about what is at risk, to me this is a structured entity. So you'll see a lot of interesting stuff coming out of this, and the reason again is worth thinking about. This is not just about consolidation, it doesn't matter. Often what happens is the margins that are retained in entity B are so small that nobody cares a damn. Okay, they get a very small kind of handling margin for whatever they have to do in terms of distribution. But the issue is that if from a accounting perspective you acknowledge that this is an entity which is a part of your organization, have you potentially breached foreign direct investment norm? That's the question to ask. So I think you'll see a lot of interesting stuff coming out there. The third example of a structured entity which I'm dealing with right now, and it just showed me how much there is that we don't know. There is this very big company, and their entire business model, backtrack. One of the things they do is whenever they want to do a new project, they never do it through the main company, right? They don't do it through a subsidiary either. They set up an entity, and they typically own between 10 to 20% of that entity. Let's assume as an example. The balance amount is held directly by the promoter, but the entire output from that plant is going to be taken by the mother entity, and that is the agreement. And at the end of a particular period, when the plant reaches a particular commercial stage and it's stabilized, the agreement is that the shares will be transferred from the promoter to the company. Now today these entities are not consolidated because you have only 10%, you don't have influence, you don't have control. But Ind AS will force us to ask the question again, who holds the balance shares? Okay, what are the activities of this entity, new entity, which is only to supply to you? Do you bear the risks and rewards? Of course you do, because that plant is going to come to you. It's a matter of timing before it comes to you, and the entire output is going to be taken off by you, and therefore many of these entities could get consolidated. Now once again, the entity consolidation is not a problem. The problem is the debt. Okay, so each of these entities have thousands of crores of debt which has been taken to fund the plant, which doesn't show up in the balance sheet today, but which post Ind AS will show up in the balance sheet as well. So what I want to leave behind with you again is that there are multiple situations where we don't even get to voting shares. Even before that, you have to make an assessment that is this a structured entity where, based on the facts and circumstances and the relation between the activities of the main company and the entity that you are evaluating, you get to consolidation. Sorry, somebody had a question there. These are what? 1 second. Can I have a mic? Mic, please.
The structured entities, these are basically consignees. Consignor is sending the goods to the consignee for sale.
No, they're not consignors. They are arm's length sales. They are arm's length sales. The point I want you to evaluate is, it doesn't matter how you do it. You got to look at the substance to say that does it entity B in this example have any real identity as compared to the entity A. So ask that question. Now 95% of entities will not be like that. Okay, I've given you 3 examples of some very complex structures. Let's move on to what happens in a normal case. The first thing that you do in Ind AS is, in addition to the voting share, you look at what else do you have as an investor. So for example, let's say company A owns 40% of company B, and now I'm back to a normal company. So just erase the 3 examples I gave you, otherwise you can get a little bit confused. So erase, start again. Okay, normal company A, normal company B. Company A owns 40% of company B. Under Indian GAAP, you would not consolidate because you do not have a majority of the voting interest. But company A has a call option to buy an additional 20% in company B at any point in time. Okay, if that is the fact pattern, under Ind AS you consolidate, which is, in addition to current voting interest, you also take into account potential voting interest that you own, if as long as it is currently exercisable. So that's one big difference that is kind of coming up in practice, where additional entities could get consolidated. On the other hand, you could have entities where you own more than 50%, but you will not be able to consolidate because the minority shareholder has rights to participate in decision making. Let me give you one simple example which will illustrate this. All insurance companies in this country, okay? So the Indian partner, let's take Prudential ICICI, where ICICI owns 76% of the or 74% of the entity, and 26% is held by Prudential. Under Indian GAAP, you consolidate because you own more than 50%. Under Ind AS, you ask the question, do you really control? And when you are asking that question, one of the things you say is, what are the rights that the minority shareholder has? If the minority shareholder has certain rights to veto certain key decisions, which is, let's say, approval of budgets, approval of business plans, approval of appointment of CEO, etc., then despite owning more than 50%, you cannot consolidate that entity. It is not treated as a subsidiary. We are seeing a big impact of this wherever companies have subsidiaries, whether it's private equity investment, because all private equity investors insist on having some of these rights, and if those rights cross over, you can get to an impact on consolidation. So that's another area where we're seeing a lot of impact. There could be, let me just come back. There could be situations where you own less than 50%, but where you have to consolidate because of a concept of de facto control. Does anybody know what de facto control is? Sorry? In reality? Okay, that's a little bit of a vague answer. You got 2 right, so I'll give you 1 wrong. Okay? Okay, de facto control, guys. No, that's not that's real control. That's not de facto. The fact they've used 2 more words, de facto, has to have some meaning. Yeah, exactly the opposite of that, but I'll come to that. So the way de facto, think of this situation. Let's say company A, and there are many cases. Company A owns 40% of a listed company, company B. Company B is listed. The second largest shareholder owns 3%. The second largest shareholder owns 3%. And all other shares, so the balance shareholding of 60% is disbursed among 60,000 shareholders. What is the chance in hell that enough number of people will come together to block any decision of this 40% shareholder? That's de facto control. Yeah. So de facto control exists when the size of the shareholding of a shareholder is significant but not majority, and the balance shareholding is so widely dispersed that the chances that remaining shareholders could come together and block a decision is remote. That's when you got de facto control. And when de facto control exists, you have to consolidate. It's not a choice. So every company which is a significant minority in a listed company will have to ask this question, that could you have more and more entities getting consolidated with you? So think about de facto control. I'm sorry? ITC is an example of this. You think BAT has de facto control of ITC? Yes. Well, arguable. No, actually you raised a very good question. I won't comment on ITC because I know a lot more than what I can talk about. But basically, I'm sorry? Yeah, no, but see, the issue, okay, let me just backtrack. The issue is not whether you have to have a parent or not. Because see, whether ITC, somebody controls ITC or not is not relevant. The question is, in preparation of consolidated financial statement, what do you need to? So actually the best example that I can use is Mahindra and their shareholding in Tech Mahindra. So Mahindra and Mahindra owns some 35-38% of Tech Mahindra. The second largest shareholder would own 3% or 4%. And that's when the question has to be asked, that is that 35% enough to give you de facto control? So situations like those. We talked about structured entities. I'll come back to this. Okay, let me go to step acquisitions first. Let's say company A owns 60% in company B already. Okay, so it is treated as a subsidiary. And let's say it buys another 20%. Under Indian GAAP, what do you do? What do you do under Indian GAAP? You add and you record fresh goodwill, because you basically you now have 40% more, so 20% more, whatever you paid for it, you compare it to 20% of the minority interest, because that will exist in the balance sheet, and the difference you plonk as goodwill. Under Ind AS, if it's an existing subsidiary, which is you own 60%, any transaction to increase an ownership there never results in additional goodwill. The difference between what you pay and what is the non-controlling interest gets charged to reserves. So that's another big difference, that goodwill never changes after the acquisition, because acquisition and non-controlling interest is dealt with in a particular manner. Let's take the converse situation. Let's say a company owns 80% in a company B, and sells 20%. What do you do on Indian GAAP? So it sells in the open market 20%. What do you do? That should be easy, yeah, even for 515. You record profits, which is you take the carrying value of that investment. So you held 80% in your consolidated financial statement that has some value. You take the consideration you received, and the difference between the two you record in your P&L account. Under Ind AS, that goes to reserves. Even if you sell an investment in a subsidiary, as long as you set it continues to be a subsidiary, it goes to reserve. It does not come to the profit and loss account. So all of this, we hear a lot about this monetization. Value unlocking? Value unlocking. So you have subsidiaries, you keep on selling some shares in the subsidiary, consol financials, you have some profits coming in period on period, that goes away under Ind AS. So just think about how that could be applicable. Put options is a very complex topic. I'll try and deal with it at a very simple level. Let me take an example. In the real estate industry, it's very common when a new project, let's say there's a real estate developer, they have a new project, 100% owned subsidiaries running the project. Often they get PE investors and they sell, let's say 20% to the PE investor. Yeah. Most of those agreements say that at the end of 4 years or 5 years, whatever that time may be, if that project does not give an IRR of 18% or 20% to the PE investor, then the investor has the right to sell the shares back to the developer at the price which was paid plus a return of 18% or whatever that might be. That's a put option on the subsidiary share. Under Ind AS, if you have a put option, that's a liability, which means one, you don't recognize the gain. First of all, remember, this developer would have recognized the gain on the 20%. Not only do you not do that, but you recognize the liability. So the amount that is paid by the private equity becomes a liability in the consolidated financial statement. Every year you charge interest at 18% or whatever you offered as a return, such that at the end of 5 years, when you reach that repurchase point, that's kind of settled at that point. So that's a put option example. What I wanted to do once again here is just give you a flavor that this is all very different from the way you understood consolidation. I don't know what your expectation from this discussion was, that this is not just about when do you consolidate 50 versus other. There are many areas where the way we prepare consolidated financial statements or what we take to profits versus what you take to reserves is going to change under Ind AS. Alright. Last point is there is an exemption under Indian GAAP currently that if you acquire an entity with the intention of disposing it in the near term, control is temporary, you don't consolidate, that concept goes away. So if you have any of those entities, they will have to be consolidated until you actually sell them off. Okay, joint arrangements very quickly. 2 comments I'll kind of do and then I'll open it up for questions. The first is that in the Indian scenario, if you have a separate entity over which you have joint control. Joint control exists when 2 or more parties have control and there's an agreement through which they have control, which is very similar to our AS27 definition. If you have joint control, then it qualifies, and it's a separate entity, it qualifies as what is called a joint venture. And like I briefly alluded to earlier, if you have a joint venture, then you do not do proportionate consolidation method, but you do equity pickup, one line consolidation. Can somebody tell me what is the implication of this? What is the implication of doing proportionate consolidation versus one line pickup? I'm sorry? Turnover is not coming, so top line goes away. Profits are the same, right? Profits remain the same. So turnover goes away. What else? Ratios change. Sorry, you were saying?
Size of the balance sheet.
Size of the balance sheet. Is it good or not? Smaller size is better or worse? Sorry?
People like the big size.
That depends on how much debt you have. Okay, so now this is all very grey. This is all very grey. There are people who believe that this is positive because it deleverages the balance sheet. A lot of debt which was there in jointly controlled entities will go away. A lot of people who want turnover, right? For example, I work with a very large infrastructure company, very large. The book that we have over the next 5 years of projects which will be run through joint ventures where we would have done proportionate consolidation which will go away is $6 billion, 30,000 crores or 34,000 crores or something like that. 34,000 crores of revenues which we would have had over the next 5 years will no longer come in our consolidated top line because of this one accounting change. We don't like it, but that's the way it is. So that's one part to it. The most interesting comment I heard was I was with a telecom company, and we were discussing this. They have a entity which is a tower company which is proportionate consolidation, and we were discussing these things, and suddenly they realized, they're like, shit, we are in trouble. And I said, what happened? I said, your profits don't change. I said, everything is the same. They said, oh my god, the market values us based on EBITDA multiple. The whole telecom industry globally, not just in India, is valued on EBITDA multiple. That's how Vodafone globally is valued, that's how Vodacom is valued, everybody. Now what the market has been doing till now, what analysts have been doing till now, is they've been taking global EBITDA multiples, okay, which are all based on no proportionate consolidation already for the last couple of years, and taking that multiple and applying it to an EBITDA which is already inflated, right? And now that EBITDA will no longer be the EBITDA because it will change to a lower EBITDA. Now they of course need to go back and convince the market that look, nothing has changed as far as the business is concerned. So this whole EBITDA reducing by 400 crores or 500 crores really should not have a 3,000 crore impact on our valuation. I think it's a good discussion to have. So I think what I want to leave behind now finally is to say that in acquisitions, consolidation and joint arrangement, all three areas, some fundamental differences coming through. Impact would depend upon, really what transactions your company, or if you are working with a company, advising a company what they are doing and what their transactions are, but it's likely to be a fairly significant impact in each of these three areas. With that, I'll pause and I'm happy to take questions. Yeah, I know you're a bit tired, but you still can ask questions. Okay, two questions here. Okay, so let's go ahead.
How the audit risk will be impacted by implementation of IFRS?
Okay.
Number second, how much reliability of the financial statements will be impacted? So far the users are concerned.
Yeah.
Minority shareholders.
Okay. I think from an auditor's perspective, audit will definitely get more challenging because remember earlier there was a framework. You could say Indian GAAP was judgmental, but at least there was something which you knew how they would work. More than 50% consolidate, less than 50% don't consolidate. But now it's different. So audit, to your question, will become more judgmental, more risky, more responsibility. Users will have to be very careful. For companies where they do not, where there is no, where there is no risk of governance, the Ind AS will actually give a truer picture of the financial statement. But where governance is already shaky, Ind AS will give people an opportunity to further do things which may not really be compatible. So I think the challenge is, there's no right or wrong. The challenge is Ind AS is just one spoke in the wheel. You have the thing on audit, you have legal enforcement, all of them have to work together for us to get to better reporting. Yeah. Somebody else had a question.
Yeah. Hello. For the jointly controlled entities, if they are going for merger, we are not doing a fair value. What is the reason behind that?
Explain that again.
Suppose there are two jointly controlled entities and they are merging. We are not fair valuing the acquired company.
You're talking about accounting in whose books?
Common control entities. Common control entities. One is acquiring the other. We are not fair valuing the acquired company.
Yeah.
So what is the reason?
I don't think that's the right thing. So let's say there is a 50-50 joint venture. No. What's your question?
Both the companies are controlled by the same parent company.
Both the companies. Okay. Yeah. Okay, got it. Oh, that's not joint. That's common control.
Common control.
Why are we not fair value?
Yeah.
Oh, that's the wrong answer. We should fair value. I agree with you. Yeah, I don't agree with that. I mean, which is why. Let me give you a slightly more serious answer to that. IFRS 3 actually said we don't want to get into this debate at all on whether a transaction which is common control should be fair valued or not fair valued. The conceptual reason is that a lot of people feel that if you are buying shares from a promoter, in this example, this is another form of paying dividend to the promoter. You could always inflate and pay dividend, and that is why it is a charge to reserve. But others have argued that that's not the case. As long as the transaction is on an arm's length basis, which under corporate law many transactions have to be today, then why should you treat a transaction with a promoter any differently from a transaction with any other party? Which is why IFRS 3 stepped out of this debate, and globally you can do both. That's the choice in global IFRS. But in AS, when there was a lot of debate within the institute, I think people just gave up and they said, let's just go for one accounting, which is book value accounting. I don't necessarily agree with that. No, so I'm with you. Questions?
Another question.
Yes, please.
See, I was looking at some oil and gas company balance sheet in the Caspian region. They are having these jointly controlled entities to
Yes.
80% extent.
Yes.
So once they are coming into equity method, so isn't there a chance of not getting a whole idea how much revenue was generated from the production?
Yeah. So what happens?
Work on that, I know.
Yeah, no. But what happens there is just because it is accounted for in one line does not mean that you don't give disclosures in the financial statement. Sorry, I didn't cover that. So Ind AS 1112 ask you if there are significant jointly controlled entity where you're doing the equity method, you have to give the summarized financials as a part of the notes to the financial statement. So that information will be there some way or the other, except in accounting it will not show up in the main P&L.
But if there is an environment of leakage,
Sorry?
If the economic environment is such that there is huge leakage after the production,
Yes.
there is a huge chance of revenue leakage for
Yeah.
the oil and gas sector.
Yeah.
So this equity method,
I don't think that's relevant, because that entity, how it's run its operation, what the control environment is, that will happen. This is accounting and how it's reflected in the financial statements. Okay. Yeah. The back.
Sir, what about the multiple controls like which I spoke about? Supposingly I am having 10% and another one is having 10%. And how do the subsidiary would know that who is consolidating?
No, you know, but no. I think that's a very good question. Actually, it's a very basic question. Sorry, I thought we would have understood that by now. There is no requirement that somebody should control. And I think this goes back to the point that was made on ITC also earlier. If it's a situation where there is no shareholder who has got control, then there is no controlling shareholder, period. Nobody consolidates. So it is nobody's subsidiary. That's okay. It's not supposed to be somebody's subsidiary. Yeah. Okay. Any other questions? Yes, a couple here.
So is it just control or controlling the director, or it's also a custom to act as we have in Companies Act? So can there be cases where same company is consolidated by 2 or 3 companies?
No, it cannot be. It cannot be. There cannot be a situation where, because remember, which is why Ind AS says who has control. All factors go into a box to say who has control. And if you get to a situation where more than one organization has control, then there is no control. It is joint control. That's where you get to a jointly controlled entity. So there cannot be a situation. I mean, we've had this debate. As you know, AS 21 said that subsidiary is an entity in which you have more than 50% of the voting stock or more than 50% of the board of directors. Now, under a shareholders agreement for a private company, you could have the entity that has got less than 50% have the right to appoint a majority of the board, and theoretically both could consolidate, but that situation does not exist under Ind AS. Yeah. So one question somewhere else here. Yeah, you had a question.
You have answered.
Okay, brilliant. Thank you. That's my unique ability to answer a question without hearing it. Yeah. Okay. 5 minutes. Any further questions?
Yeah, I have a question.
Yes. Where are you?
Behind you.
Oh, I'm sorry. I am so sorry.
You had said about this real estate transaction put option. Typically, the put option is by the promoters.
Yes.
And the buyback is done by them by a separate entity and not by the same entity. In that situation, how the investment could be a liability and the interest recorded in the main company?
Okay, it's a very good question. The way Ind AS looks at this is to say that if you have the question was you have a put option, but the put option is not it's on the promoter. So let's say that the developer, there's a subsidiary, developer sold in the subsidiary, put option is on the controlling shareholder of the developer. There are two views. One view is that this is not a liability as far as the developer is concerned, and therefore this should not result in liability accounting. That's one view, and that's kind of accepted in many quarters. There is another view that in this case the promoter is doing this only on behalf of the main co, and therefore it is a liability of the main co which is being assumed by the promoter. So you then have a double kind of an accounting, which means that this is treated as a liability and a distribution to the promoter, i.e. the promoter. So let me make it simpler. Let's take a case where a promoter gives stock options to employees of us, that they should continue with the company. If they continue, the promoter will discharge the option liability by issuing shares from their own shareholding. Ind AS says that in that case the company should still record an expense even though the company is not giving any shares, but is being given by the promoter. So the entry you record is you expense and you parallelly say that the promoter is contributing to the company. Yeah, but there is a view, you're right, there is a view that this is indeed not a liability of the company. So I would be very interested in that debate as the Ind AS implementation committee moves forward. I don't know if somebody from the committee is here, but that's what makes our lives very interesting. One last question before I leave. Anything else which we've not covered, or it's all crystal clear? Okay, if it is crystal clear, thank you very much for your time. I enjoyed this and hope you have a good day tomorrow as well. Thank you.